Hello, I am Louis Montalembert, the Principal Manager of the PAM Cloud Fund at Revolution, and I thank you indeed for attending this web conference during which we will discuss the company results for the very first quarter of 2024. It is always an opportunity to revisit our theme. For those who are already familiar, I apologize, but I'm going to go over the key topics of the theme again. So the cloud, what we generally mean is indeed the infrastructure such as that dominated by Microsoft Azure, AWS, and Google. We are more focused, and what interests us primarily is what I call the cloud superstructure. That is indeed the entire world of platforms as a service and software as a service that has developed with the advent of the cloud, which Morgan Stanley calls Cloud 2.0. About a year ago, we added an additional layer to this cloud pyramid, which is the semiconductor layer, because we cannot overlook one of the dominant stock market themes at the moment, which is generative AI. Today, I will discuss this further. We are in the hardware moment, meaning it's the shovel sellers who are generating the most significant revenue. Obviously, NVIDIA is the star of the stock market right now. Our thesis is that the generative artificial intelligence will primarily spread through Azure service platforms and Azure service software to reach end users. So this will be a discussion that we will develop further in the presentation. Especially, we will explore even further details. But it's always good to revisit this cloud pyramid to see where we stand. We are at a point where the revenue is recurring, and that's an important aspect of our theme. Our fund is an international equity fund exclusively focused on investing in B2B cloud. We make a distinction with B2C, in which we could include Netflix and Meta, which for us have very different dynamics. What interests us is the wave of digitalization that is just beginning for companies thanks to the cloud. We have 4 sub-themes. The first one is what we call cloud migration. These are actually features that in fact existed in older legacy software and are slowly, gradually being replaced by so-called cloud-native players. The simplest example is CRM, which is seen as the world, but is now completely dominated by cloud-native players like Salesforce or HubSpot. Next, we have new uses, the ability of software to infiltrate entire sectors of the economy where they were not previously present. Thanks to the cloud, we all know and appreciate DocuSign, the fact that we no longer deal with cumbersome paper documents, but instead sign digitally. And I really like a company that is not publicly traded, I regularly talk about, called Sense, which is the cloud for laundromats, which allow the digitalization of many processes, or if you prefer Octolib for the French, which is more practical but allows the automation of appointment scheduling, contacts with health insurance, and the accounting of healthcare practitioners. This type of business model is going to emerge in large numbers across different industries in various sectors in the coming years. The cloud allows the generation of huge amounts of data and the organization of this data into signals that can create productivity gains. We have new players like Snowflake, MongoDB, Dynatrace, and Datadog. We are in a decentralized IT architecture, and therefore new cybersecurity players have emerged. 5 years ago, we would have talked about Symantec as a major player. Today, Symantec no longer exists. We have CrowdStrike earning $117 million in 2017 and earning $3 billion last year. It's truly indeed a new modern IT architecture. 4 sub-themes represent our investment theme in the field of B2B cloud technology. A universe of about 250 companies, many candidates for listing, what we call centaurs, companies that are unicorns worth more than $1 billion, but have surpassed 100 million in ARR, annual recurring revenue. That is the signal they have achieved what we call product market fit. This means they have a market that wants their product, the product works, and they are in the process of conquering their market. At 100 million in annual recurring revenue, we are structurally profitable, but generally we go after our market. So we align salespeople And so most companies that make 100 million or more have negative margins because they are in the process of acquiring their customers. So it's a bit less the case now for French players like Brevo. So there are indeed French candidates, even though today the market is narrow for French cloud players. But we are expecting Dataiku, Ecovadis, Doctolib, which I mentioned earlier, Conto, Brevo, Content Square are champions who are likely to emerge soon. The cloud theme is one of hypergrowth. Salesforce, one of the oldest players, took 5 years to go from 100 million in annual recurring revenue to 1 billion. Snowflake had a revenue of $97 million in 2018 and made 2.8 billion last year. So it's approximately a 28-fold increase in its revenue over 5 years. I used to say that this had never been seen in human economic history. Since NVIDIA, I'm afraid we've found something even more brutal in terms of growth rate. Nevertheless, this growth rate is spectacular. It is driven by a subscription or prepaid consumption model, which allows for a negative working capital requirement. Therefore, unlike the traditional economy, growth is not a drain on cash flow. It is a cash generator. No capex, since we are deploying on an infrastructure that is mature, which is the cloud, which is global, and therefore we have no limits in the commercial reach of the products. We are still at a minimal level of penetration in companies. At the end of 2022, we were at 17% penetration. Gartner says we reach 36% by 2030. Note, we will approach 100% for the cloud, not just public cloud, including hybrid clouds with private clouds. But that means all applications will be accessed via the internet, so we will have a penetration rate close to 100%, which means we are really at the beginning of the story. As proof, we haven't yet seen companies like Sense on the stock market, and Sense, which has nearly $200 million in ARR, is only serving 2% of laundromats in the United States. We haven't heard about it yet on this side of the Atlantic. So we are indeed at the very beginning of the cloud deployment, and when I say 17%, we could have a significantly richer growth rate in the next 3 years. I know that in its latest report, Gartner definitely predicts a significant acceleration in penetration this year, with growth exceeding 20%. Here is the topic we are meeting for, the first quarter 2024 results, following the publication of our focus in April, in which we set goals for the year 2024. We will discuss our overall progress and necessary adjustments to meet our annual goals as laid out in April. Objectives that ultimately reflect a litany of topics we like for this theme. It's an overfunded sector. We have growth that is persistent regardless of the future of the macroeconomy. We have profitability that is always increasing. We have abundant cash generation. And today we are at a key moment because valuations are truly very depreciated, and I will dedicate a part of the conference to this topic. To revisit the goals we set at the beginning of the year, it's important to know that these goals are always readjusted to the portfolio as it stands today, and we are in the process of we have weightings that have varied since we published the focus. So we have targets for each company, and then we compile them based on the current weightings. The growth targets were 23% compared to 28% last year. I remind you that COVID had indeed led to a significant and notable acceleration of growth, and in 2023, companies entered a mode of rationalizing their COVID consumption, so there was a kind of considerable and substantial headwind. And in 2024, we expect the end of this rationalization that we are beginning to observe. So 23% is lower than 28%, but in reality, with an increase in revenue year over year that we expect to reaccelerate. Regarding margins, there is a trade-off between growth and margins because, as I mentioned earlier, for Centaurs, the more we want to grow, the more salespeople we need to align. From the moment growth is less vigorous, we scale back in terms of salespeople, which last year led to a spectacular growth of 8.6 points, going from 7.7 to 16.4. This year, we are once again expecting margin growth as we anticipate an increase of approximately 3.8 points to reach a 20.1% margin. I remind you that the mature margin, the mature EBIT margin in this particular industry is 30% and above. So when we tell you 20%, it also gives you an idea of the composition of the portfolio in terms of the types of companies, such as various different companies that are in the portfolio. 20.1% growth, so 3.8 points with a top line growth of 23%, which meant a 52% growth in average EBIT compared to the 171% we achieved last year. But last year was an exceptional margin jump. What happened in the first quarter? We indeed have persistent growth, which is still in a slowdown mode on a year-on-year basis, as they say. Since last year, we had a growth of 32.8% in the first quarter, and this year we have a growth of 23.5%, which is in line with our expectations for the year. But we do indeed have revenue increments that are picking up again. That is to say, we see on the graph at the bottom of the page the acceleration related to COVID. So essentially, the increments are the differential. These are the rolling 12-month increments. To analyze the increment for Q1 2024, it's the extra revenue generated over the last 12 months compared to the previous 12 months. In Q1 2024, Q4 2023 is the additional figure made in 2023 versus 2022. We do it on a rolling 12-month basis due to seasonality for certain companies. So we can clearly see the optimization phase that started at the end of 2022 with rolling 12-month increments that have clearly decreased. We indexed them at 100 from Q1 2020. And since then, there has been a re-acceleration of increments. In the past year, the increment has increased by 10%. So for us, this is undoubtedly an extremely clear and very favorable and positive signal of the end of cloud consumption optimization by clients. There has been an evolution in the composition of the portfolio that has occurred relatively passively over time. I remind you that we have three types of companies. The advanced ones, which often have market capitalizations over 100 billion, are mature in terms of margin, generally speaking, generally above or around 30%, but still have a growth profile of about 15%. Then sound, then the prospectuses prospect the climbers who have passed the inflection point of the margin, but who therefore have a double effect on the margins, which is a ramp up of the margins and a top-line growth that remains above 20%. And then the prospects, which are companies that are losing money, I often tend to say reputedly losing money. They are indeed, in fact, really actually losing money because they have extremely advantageous growth profiles. In 2022 and especially in 2023, the message from the markets was that margin is preferred over growth, unlike in previous years, and consequently, many of these companies quickly became ascenders, meaning they had positive margins because they lowered their margin profiles. Today, in this category, we only have three companies left: Braze, GitLab, and SentinelOne. And these three companies should be profitable in the upcoming fiscal year. So it's true that in order to replenish the portfolio with high growth companies, we will need to have initial public offerings, IPOs. But all this to say that it is important to note that margins are managed in this particular sector. So what happened with the margins? Well, we had a jump of approximately about 5.5 points in the first quarter, going from roughly 11.9% margin to 17.4% for the first quarter of 2024. The bulk of the margin gain comes from the climbers, but that's somewhat normal because they now represent more than 2/3 of the portfolio. And then there are companies that have recently become profitable, the ones we mentioned earlier, and therefore are making more significant margin improvements, and thus more improvements, and thus achieving better results. The technological advancements have a margin that remains stable from one fiscal quarter to the next, while still contributing significantly to the overall gain as top-line growth brings a slightly higher margin across all the companies involved. And so, as you can clearly see, in this first quarter, we have a growth in average limits of 80%, which is remarkable compared to the 52% we expect for the fiscal year. It's somewhat normal for it to be more dynamic in the first quarter since we had a gradual margin growth slope last year, which will probably be a bit less this year since we're starting at approximately 17.4. We expect to end the year at slightly 20.1. This is an update of a graph that some of you have already witnessed before. Validation of the idea that the margins are driven on one hand, and on the other hand by the incredible leverage effect that growth can have on various costs and expenses. We see margin profiles over approximately 4 years with our 2024 projections, with significant margin gains of 46% for a company like Snowflake over the period and 25% for MongoDB. On Monday, which was a prospective new Ascensionist, gained a total of 68 points on the day. I'm not going to list them all, but take a company like GitLab, which had a negative margin of 130% in 2020, figures that can legitimately be frightening. And in 2024, it will be profitable. So things are moving extremely fast. In terms of the overall leverage that can be effectively achieved once the growth rates aim to be a bit more reasonable and sustainable. This is the case for Sentinel-1, which had over 100% negative margin in 2020 and will be profitable this year. So that's already 2 of our prospects that will become high achievers this year. The free cash flow margin is an extremely crucial point in this sector because, as I mentioned earlier, we have a significantly and consistently negative working capital requirement of around 25% of revenue. This means that when we acquire new customers, we typically bring in cash. Subscriptions are often paid in advance or for future consumption. And so this is one of the attractive features of this sector. If I compare it to a company like Stellantis, Stellantis makes 10 billion in EBIT, but only 4 billion in free cash flow. Here, on the contrary, we are dealing specifically with free cash flow that is higher than the operating income, precisely due to the characteristics of the sector in this context. And then I would like to mention that we might have 1 or 2 additional points of CapEx, which is indeed quite minimal. And the most interesting point is to look at our prospects. Even though they only represent 10% of the portfolio, they provide a typology. We are looking at negative margins of about 5% IBIT level, have an FCF margin of 18%. So this means that we don't have any financial drain in the portfolio companies. We are indeed really seeing extremely advantageous and very beneficial cash flow generations. So at the level of our current discussion, it seems we are missing the slides on cash flow. Let me just check quickly to see if I can find them and resolve the issue. There was a small issue in the preparation of the presentation. Regarding cash flow, we generated another 7 billion in cash flow from the 32 portfolio companies. We have reached 56 billion in net cash flow from the portfolio companies, which generates an additional 4 points of margin, a crucial factor that is absolutely key to the financial health and overall stability of the portfolio companies, ensuring their long-term success and sustainability. The additional 4 margin points partly explain why our free cash flow margins are significantly much higher than the limit margins overall. So what happened in terms of performance metrics overall? I updated the graph that I had previously shown during the lunch break around the focus topic, and so just like last year, we observed a rise in prices until mid-February, which was followed by monetary anxiety around central bank policies, which led to a drop in prices. Unlike the previous year, at the time of the quarterly results announcement, we continued to see a decline in prices. So the first thing to note is that I don't think we have changed regimes, meaning that in the year 2022, we had a regime that was totally correlated, and the rise in interest rates was the main determinant of the drastic drop in costs in 2022. In 2023, there were points of monetary anxiety, but the main determinant was the ability of companies to show growth in their results. Last year, the fund achieved a 47% performance versus 35% against the BVP Emerging Cloud Index, which is an index from which about 3/4 of the portfolio is derived, making it very representative as it is entirely B2B cloud. Since the beginning of the year, we haven't been able to differentiate ourselves against this index, even though the profits are in line with our expectations. And there are indeed two elements to this, one of which is indeed a decline, well, a continuing and ongoing, persistent and ongoing monetary anxiety. But the second and truly most important factor is that the software is indeed a victim of a double displacement effect, significantly related to the hardware moment of generative AI. And we will come back to this a little later. There are slides on this topic. In terms of valuation, this brings us to a level that seems quite drastic to us, because today, in terms of sales multiple, for the current portfolio, we are at a sales multiple that is lower than the sales multiple at the end of 2022. At the end of 2022, I would like to indeed remind you again that we experienced a crash of approximately 50% for software stocks, which I called specifically the 2008 of tech, with this skyrocketing of interest rates. There was significant monetary anxiety, and we had a significant derating. Simply put, we were coming from multiples that were spectacularly high, driven by the collapse of interest rates in the previous years, but we had a derating of 77%. It turns out our multiples today are still 6% lower than something I already considered excessive at the end of 2022. Moreover, we see multiples of free cash flow for 2025. We have made assumptions or multiples of EBIT for 2025 using conservative assumptions, which are 32 times for EBIT and 24 times for free cash flow. We like to have a bit of PEC reasoning comparing multiples, because clearly one might think that 32 times 2025 is still a high multiple, but compare it to the potential for growth. If we compare these multiples, we look at the EBIT level as it is the cleanest multiple, and we are relatively conservative because in reality, we are in a sector where EBIT is often lower than net income because we have the interests I mentioned earlier. And in this sector, we have a lot of tax loss carry forwards, so we won't have taxes for the coming years. So we are relatively conservative using EBIT multiples, and we see that we have PEGs, which looking at 2024 and 2025 are between 0.8 times and 0.9 times. We are between 0.8 and 0.9 for companies with revenue 100% recurring and net cash of 56 billion, 32 companies in portfolio. So it's exceptionally low considering the risk profile of these companies that don't need financing at all indeed, which have a considerable safety cushion and recurring revenue with pricing power that is truly the archetype of the definition of pricing power, meaning that the service they provide to their clients is critical, while the price paid by the clients represents an infinitesimal part of the cost base of the client companies. I like to mention the very important case of GitLab, which is indeed a coding platform, and also one of the important portfolio companies that launched its AI feature, which we will discuss a bit later, initially priced at $9 per month per user, and then raised to $19 3 months later. So this gives you, in essence, the price elasticity of the sector, hence the overall pricing power in the market. So 0.8 times seems completely disconnected from the reality of these companies, which would deserve at least twice that, given the fact that we have long-term growth. I'm not going to be ambitious, but if we are at 1.5 times, it means we have an appreciation potential of 70 to 80% for our portfolio. if I go back a bit further by looking at the evolution of the BVP Emerging Cloud Index, we regularly show you this updated curve that displays the forward valuation multiples of the companies that make up this index, which is exclusively B2B cloud, and that is a bit more detailed. We can see that today we have indeed returned to 5 times the valuation we had before the bubble period related to interest rates. And so, as I often say, over 10 years, we are definitely looking at a constant multiple, which for me, coming historically from private equity, is very comfortable for generating returns. And we see that the returns over 10 years are extremely favorable for this theme. It's the last 10 years, I think it will be extremely favorable in the next 10 years for all the reasons I mentioned earlier, namely the underpenetration of the cloud in today's technology stack of companies. I talk a lot about this hardware moment compared to the software moment. For us, the software moment will definitely ultimately follow the hardware moment. So where are we today? In fact, today, actually, indeed, we have an arms race among what we call the hyperscalers, the mega caps you're familiar with, to release the best foundational model LLMs. So we see Microsoft betting on OpenAI and Mistral, Alphabet with Gemini, AWS with Cloud making investments in Tropic, Llama with Meta, and we saw in Apple's announcements last night that they are betting on OpenAI for their future products, including such as AI-driven innovations. And so this arms race leads to absolutely explosive capex from the hyperscalers, because over 5 years, and here we have taken the estimates for 2024 and 2025 from Goldman Sachs, just these 4 players have tripled their capex to approach 200 billion. And so, this obviously benefits instantly those I called the shovel sellers, the semiconductor companies. So if we look at the stock performance since the beginning of the year, we see that the average of the stocks I have chosen here in semiconductors is up 77%, while the EM Cloud, the BVP Emerging Cloud Index, which is a cloud software index, is down 12% since the beginning of the year. There is a double crowding out effect that we consider to be temporary. There is one that is a surprise for us, which is operational. That is to say, since the beginning of the year, since the end of last year, but it is visible this year, there is pressure from CEOs on their CTOs to make business cases for generative AI. And so chief technology officers are forced to divert some additional resources towards generative AI applications without increasing IT budgets. So we achieved our growth targets in the first quarter. But what led to the cost reduction at the time of the announcements is that software companies have been extremely cautious for the rest of the year, because they indeed see that budgets are increasing very little and there is less momentum for growth given this effect, which we believe will be temporary. The second obvious thing is that in tech allocation, immediate and current flows are obviously generally favored over future and potential flows. In other words, investors are rushing to semiconductors today in the market and technology sector significantly. I believe I read a statistic that said NVIDIA is in 9 out of 10 portfolios. In 9 out of 10 portfolios. And so it is indeed done at the expense of the software, which has been significantly oversold in recent weeks. We have 4 predictions about generative AI. The first, in our view, is that foundational models will become increasingly commoditized in the near future, and more. I spoke with an investor yesterday who told me they are going to win big. We think that's not the case at all. It is indeed widely believed that the various models will be roughly equivalent to each other and that the overall training cost is plummeting. It should be noted that the training cost of ChatGPT-3 was approximately $100 million. 6 months ago, the numbers I saw 6 months ago would have cost $4 million for the same training. Today, maybe those $4 million, if we take the B100 or B200, the latest GPUs from NVIDIA, maybe that cost has dropped to approximately $2 million maybe even $1 million potentially. So there is Moore's law, which applies to the significant collapse of semiconductors, or at least the remarkable and considerable increase in their overall capacity at a constant price. The second thing is indeed open source, and it's Meta that actually started the hostilities by launching the AMA in open source. So open source allows for free improvements and enhancements, and I could also add new innovations, and that's Mistral, the curation of data. In fact, Mistral managed to train its model with much less money because it better qualified the data it used. So instead of using a huge amount of data, which is expensive, he used much less but achieved similar effects. So we see that there is a collapse in cost and eventually an efficiency of these foundational models that becomes roughly equivalent. On the other hand, there is a truth we cannot escape. Today's CapEx are tomorrow's depreciation expenses. That is to say, the CapEx plans I showed you will weigh on the profitability of tomorrow's hyperscalers because it will translate into depreciation allocations, especially since hyperscalers had to equip themselves in a bottleneck context, paying very high prices for capacity. Today, the CapEx to sales ratio in generative AI for hyperscalers is much lower than the ratio they have for traditional cloud workloads, significantly. This is something to watch with the hyperscalers. The third point is generative AI will spread through software. It's inevitable. In fact, generative AI is not going to replace humans. In any case, not in the next 10 years. I participated in a roundtable with Rex and Code, with economists who were trying to see how AI could replace humans. Given generative AI flaws, they said it would take time. That's not how it will work. The way it works is that generative AI equips software and makes the human an augmented human. The augmented human replaces other humans. And I really like the example of the generative AI feature from ServiceNow that was launched in the fourth quarter. It was the biggest launch in the company's history. We're talking about a company that generates $9 billion in revenue, which equips people who handle the back office of e-commerce. For example, in dealing with an accident during delivery, a delivery that arrives broken to the customer, which is very human intensive, requiring an agent to converse with the customer, deduce a solution, implement that solution, and make a report. All of this is manual. With ServiceNow's generative AI module, we have a bot that handles all initial contacts with the customer, suggests remedies to the agent, clicks on the remedies, and then the generative AI writes the report efficiently, effectively, and accurately. This means that this agent, augmented by generative AI, can handle 3 tickets where it used to handle only 1. That's the future of generative AI. And finally, by the way, there is a study released by Morgan Stanley on what they call Cloud 2.0. They estimate the economy just in the United States, which is a significant part of the global economy, at $4 trillion in personnel costs, and that software, which is becoming increasingly important, could capture up to $400 billion of the American economy. So for them, the software market, thanks to generative AI, will expand from approximately $200 to $400 billion. This is a prediction from Morgan Stanley. The fourth point is that the winners of generative AI will be the end users. And this is a prediction that was made by Bessemer Ventures last year in their State of the Cloud 2023. And in fact, we provided a detailed and comprehensive illustration for this PCM AirVenture prediction, which we find very interesting. You know that one of the capabilities of generative AI is to code automatically. And so, indeed, there are applications that were released at the end of the year. We were just actually talking about GitLab Duo, the company we are invested in called GitLab. GitHub, which is a company that was acquired by Microsoft, released GitHub Copilot, which has roughly the same features as GitLab Duo. And so there was an experiment conducted by a third party, not by Microsoft, with 95 participants 1995 coders, 95 developers, 45 using GitHub Copilot, and 50 not using Copilot to perform a standardized task among these 95 developers. 78% of those who were equipped, they finished the task and completed it in 1 hour and 11 minutes, while of those who were not equipped, 70% finished it in 2 hours and 41 minutes. So the proven productivity gain in this study is a significant 56% overall using GitHub Copilot. The annual cost we undertook the exercise to determine the productivity gain for a company using GitHub Copilot or GitLab Duo. A developer costs $160,000. Developers spend 30 to 50% coding. A study, if we take the most conservative productivity gain, thinking he codes 30% of his day and achieves a 56% productivity gain, the productivity gain in dollars is $26,881. The cost of the most expensive module, GitLab Enterprise or GitHub Copilot Enterprise, is $39 per month or $468 per year. For $468 per year, you can save $26,880. The software's take rate is 1.7%. Save $26,880 monthly. Tech rate is 1.7%. The value proposition is definitely clear, and this is an illustration of what will happen in software thanks to generative AI. We will send you the detailed and comprehensive presentation of the AI features, including various aspects and functionalities that have been released by a number of companies within our extensive portfolio. All the companies in our portfolio will have released their AI feature by the end of the year, which is generally done using what are called APIs with the large foundational models. And what's interesting is that, once again, they are completely agnostic. If tomorrow they use ChatGPT and ChatGPT raises its prices, the next day they can use Cloud Anthropic or go to Gemini, because there will be essentially very little difference in the overall performance and efficiency of these various different models. We will send you this presentation to get all the examples of features. Let's get back to automation, assistance, and exploration, as I remind you that software is nothing more than a human-machine interface. So we've all tested ChatGPT. ChatGPT is what allows us to replace a number of functions that humans currently perform manually. And so it's quite obvious that in software, we will definitely be able to automate many functions. So what to expect next in the near future? We initially created this graph some time ago and meticulously updated at each meeting, and very thoroughly drawing an analogy to 2008, since 2022 is said to be the 2008 of tech, to see how the hyper-growth companies of that time eventually rebounded in the following years. And we see that the rebound has been extremely significant, and ultimately, if at the time the hyper-growth companies were Salesforce, Microsoft, Google, Cisco, Qualcomm, etc., today it is the B2B cloud companies that are experiencing hyper-growth, and one might have expected to see such a significant rebound. We believe that, in our view, there is still an extremely significant rebound, but for now it is clear that it hasn't happened yet. Today, we see an over-positioning of investors in semiconductors and a historically under-positioning in software. Therefore, our thesis is that the rebalancing of financial flows is inevitable. And if we come back to our vision of our portfolio, we engage in this exercise, so we have projections for all the companies in the portfolio to look at what the sales multiplier we expect in an extremely cautious manner over the past 5 years, and to compare it to the evolution of stock prices. And it's a very visual way to see the D rating compared to 2018. So here we are before the bubble, since we have indexed both. The red line is the evolution of the stock prices of the current portfolio that we have at the moment, and all this without starting in 2018. We can already see that historically over the past 5 years, revenues have increased by 5.7 times, which translates to an annual growth rate of 42%. We are quite cautious in forecasting 21% annual growth over the next 5 years. I think we are being very cautious because if Gartner is right that it's 17% for the entire cloud, and we are investing in the leaders to have only 4 additional points of growth, in my opinion, that's extremely cautious. So we could be above. We are not adding the option of generative AI in our figures for now because we don't know how to quantify it. So the famous 200 to 400 billion in software, approximately estimated by the analysts at Morgan Stanley, is not in our figures. And yet we have a D-rating over the past 5 long years with a sales multiple of 60%. For 100 agreements by taking this into account. This low evolution of 100, and if we estimated that today's multiples are sustainable over a long period, I believe they are too low. And therefore, if we remain at constant multiples over the next 5 years, the expected growth of the portfolio companies should lead to a fund performance of around 20% per year. It's a simple view, but sometimes the simplest approaches are the best for getting an overall perspective. When it comes to my investments in the fund, it's a view I completely adhere to. So to conclude, in summary, the theme is clear and it is very specific. It is indeed quite unique. We are dealing with a transformation that is largely immune to economic cycles. It is central to companies' productivity gains and will be even more so with productivity gains related to AI. I recently saw a study released by Edmund Rothschild that predicts 3 points of productivity gains per year by 2030, thanks to generative AI. I think Morgan Stanley is at 1.5 points, but that shows you that the expectations are massive and I think they are realistic. So I can't comment on the exact amount, but they are realistic about the fact that productivity gains will be massive. This is a theme that cuts across various areas. In this conference, we talked about automation, so you can see that we are going very far in terms of cross-functionality and the various aspects of multi-sectoral aspects and the different facets of it. We are dealing with companies that have extremely strong fundamentals, and our entry point is historic since it is below the valuation entry point of late 2022. And I leave you with this thought.